Welcome back. You're still tuned into Mid-Cap Radar on CNBC TV18. Let's get a corporate conversation going. Rajiv Mantri, Chief Financial Officer at Bandhan Bank, joins us now from the Motilal Oswal Annual Global Investor Conference. And we'll focus on three main points in the segment. Will the loan book growth pick up from here on? NIM's or NIM's trajectory as the loan book tilts towards secured portfolio, and levers for return on assets going ahead. Mr. Mantri, thank you so much for joining in today. Let's start with the first thing, and that's the loan growth. It has taken a backseat for a while. You got it for 8 to 9% growth for FY26 during our last conversation. You also indicated for around 15 to 17% CAGR growth over the next 3 years. Is that still intact? Can we see that growth come by in the second half itself?
In terms of the loan growth trajectory, definitely we've seen the industry level growth coming down. Almost 5 quarters ago, what used to be at 20% industry level credit growth is now down to almost 9.8%, right? As within that context for us also, we had seen in our Q1, I think the overall loan growth being around 6% year-on-year basis. But actually, if you look at the components within that, our secured book, which is the non-EEB book, which is the non-microfinance, that grew by a good 27%, right? And I think that momentum is what we still see continuing. That's largely led by a retail business, our commercial banking business, as well as the housing finance business. So that momentum is on. On the other hand, for microfinance, which we call as emerging entrepreneur business or EEB, we actually saw 15% year-on-year decline. Now for that, actually industry context is industry declined in the year by almost 17%. So we did slightly better, but that's where we expect the trajectory to start picking up. We're looking at a moderate growth of say around 5% or so. And we do expect, I think by the end of the year, towards the end of the year, that trajectory should come through. So our overall guidance of 15 to 70% credit growth is something that we will still stick by. And the reason being that we are confident about the momentum on the non-EEB business. And I think on the EEB, there will be definitely sequential recovery that we expect, especially after the monsoon cycle from Q3, sometime in Q3 onwards, where we expect that the recovery should start to come through.
Mr. Mantri, good afternoon. Thank you for joining in. Do you as a bank have any aspirations for growing in the secured segment this year? You have around 52% of your book, which is in the secured assets now. What are your near-term targets? Where you find comfort given the risk-reward ratio from the secured to unsecured business?
So I think secured mix, we've seen really good progress. In March 2024, we used to be at 42%. And by June 2025, we are at 52%. So we've done almost a 10% increase. I think by FY27 end, we expect this ratio to climb up further by another 5 to 6 percentage points. And that is primarily driven by a higher growth that we are actually expecting in our secured business, which is housing, retail, as well as commercial banking. Whilst the EEB or the microfinance book will grow, but that will grow at a more moderate pace. And therefore, as a result of this pace of change, I think the secured mix will grow further. But we see at least another 5-6 percentage point increase over the next 7 quarters.
Okay. Mr. Mantri, you did mention that NIMs will remain weak next quarter and improve thereafter. Is it fair to assume that exit NIMs will be around the same level as quarter 4 of FY25, which is 6.7%? I'm asking this as you're tilting your portfolio also to secured assets. What should the normalized NIMs be where you find comfort now?
So I think on net interest margin or NIMs, there are 3 or 4 factors to talk about. One is clearly as our secured mix is increasing, we will see some bit of a moderation on the NIMs will come through, right? Between the EEB book and the secured book, there's a 10 percentage point difference in yield. So therefore, a 5-6% increase further would mean a 50-60 basis point impact. But that's over the next 2 years, right? By FY27 exit. During the year, what's playing out as a second factor clearly is the repo rate reduction. So as you know that the repo rate reduction which has come through has impacted some portion of the assets immediately. So from Bandhan Bank's perspective, 45% of our advances portfolio is repo linked. In the first quarter, we saw a 25 basis points reduction, and in the second quarter, about a 75 basis points reduction, which is affecting the 45% of the portfolio, right? Now that impact comes through immediately. But what we've done to offset this reduction, plus also I think 5% of our portfolio, which is MCLR linked, we have a 200 basis points reduction there. So some bit of an impact there also. But what we've done to offset this is that the deposits rate we have relooked at. So in the savings account, we've already done certain reductions, which have come through from the month of May itself. In the first quarter, compared to the fourth quarter of last year, we saw 19 basis points reduction in cost of deposits, and that's because of the savings rate reduction. Some bit of reduction further is coming through in this quarter, but the term deposit reductions that we have done, which largely see an impact in Q4, some in Q3, but mostly in Q4 and some portion in the first half of next year. Because the term deposits, when they come in for repricing or renewal, is the stage where you'll see the benefit come through. So there is a timing sort of a difference where the repo rate immediately impacts some portion of the book right now from an asset perspective, but the offset will come through over a period of time. So you may see, say, the NIMs softening a bit more, but then climbing back up again. The third factor is the slippages. As the slippages reduce, which is our expectation going forward in the Q3 and the Q4, the interest reversals will be lesser, and therefore that will also give some bit of a benefit. So I think it's a function of these 3-4 factors and how it will play out. So as a result, we may see, say, NIM softening a bit steeper in this quarter, but thereafter increase up again. But overall, I think the NIM trajectory should be aligned to the guidance that we're given.
What about credit costs, Mr. Mantri? You have guided for 2.5%. Now, do you see any risks to this target? Because there have been some concerns with regards to your return on assets. And apart from the lower credit costs, what other levers do you have in place to get that ROA back above that 1.5% level?
So I think on returns on ROA, I'll probably give a slightly longer term trajectory. What we have said and what we guided is by the exit of FY27, I think we should be able to reach somewhere around 1.8% ROA, give or take 10 basis points. Of course, what our starting point right now is for the full year, financial year 25, we are at 1.5%. But because of the elevated risks or delinquencies in microfinance, our latest quarter, which is Q1 FY26, was around 0.8%, right? So the trajectory is really from the 0.8% to a 1.8% over the next 7 quarters. How that will happen is really a function of that the EB book should start to grow up again, right? The trajectory of growth, which is still not witnessed, we are expecting by Q3, Q4 will start to pick up. The portfolio quality improvement should start to kick in sometime in Q3 and Q4. Sequentially, we are seeing an improvement, but we are expecting, let's say, the cycle becomes a lot better by Q4 of this year and then sometime into FY27 as well. The third is really the various investments that we're doing in terms of our cost, in terms of investing into talent, technology, as well as infrastructure, especially to do an accelerated shift towards a higher secured book, as well as grow our deposit franchise further with the right quality mix. I think those will start to play out its dividends. We are building into a lot of capabilities, newer areas like trade, transaction banking, FX, and so on and so forth. That should start to result some benefits as well. And of course, once the credit cycle normalizes, how the credit costs will play out, I think that will be another determinant. So I think that's the reason, that's the way in which the trajectory will move from the current 0.8% to the 1.8%. Of course, the timing of it will depend upon how each of these factors play out by themselves.
All right. Thank you so much, Mr. Mantri, for joining us and giving us details on the outlook going forward on NIMS and ROA as well. That's the word coming in from Bandhan Bank.